Welcome to Accounting 201 at Kapiolani Community College. I'm going to quickly walk you through all of the notes for Chapter 13 so that you can get the lowdown on how to do a statement of cash flows. First thing to note is that statement of cash flows is one of the three required financial statements of a business, required by generally accepted accounting principles. The purpose for the statement is to show why cash changed by the amount that it did during the current period. You notice that our original financial statements that we've learned to produce since Chapter 1 are based on the accrual basis. So that means revenue is recorded when it's earned and expenses are recorded when they're incurred, regardless of what happens to cash. Well, the statement of cash flows is all about cash. So what it does is it takes information from the income statement and it takes information from the balance sheet, mixes that together, and comes up with how much cash the company received and paid during the period for its operating activities, its investing activities, and its financing activities. But it does it in kind of a weird way as far as the operating activities is concerned. It really doesn't look like information that's helpful, but it does move you from the income statement net income to how much cash was received for that kind of activity. So there are three kinds of activities that a business can be broken down into: operating, investing, and financing. Operating activities are your main business activity. Investing activities are the kinds of things that you do when you're investing in regular traditional investments or bulking up on assets, long-term assets specifically, or loaning money out. Financing activities involve issuing stock or providing a return to our stockholder, like through dividends, or borrowing activities. Now, related to this are activities that have impact on our investing or our financing activities but don't involve cash. Or maybe they partially involve cash, but then there's a lot of stuff that doesn't involve cash. So those would be things that had an impact on the balance sheet but didn't provide or use cash. For example, we purchased a commercial building by paying $100,000 down and signing a note payable for $2.5 million. The $2.5 million wouldn't show up unless we pick up non-cash investing and financing activities somewhere on our statement of cash flows. There's a supplemental schedule that will do that. Non-reportable items are items that are like cash, but they aren't exactly the same thing as your regular checking account. So we wouldn't show those because they're the same thing as cash. So we just lump all of them together with cash. Examples might be commercial paper of Microsoft Corporation. That's like a 1 week loan of $5 billion that's going to get paid back in 1 week. And so it's essentially the same thing as cash. So you take the net increase or decrease in cash flow from operating activities, so whether it was positive cash flow or negative cash flow, positive or negative cash flow from investing activities, positive or negative cash flow from financing activities, and all of them together will give you your total net increase or decrease in cash. So the statement at the bottom takes what cash used to be, that net increase or decrease in cash, and now what cash has turned out to be as of the end of the period. Now, there are a bunch of areas that are kind of strange and need special attention because you have to remember their special treatment. Those, for example, are depreciation or amortization. Depreciation and amortization, you might recall, are recorded through a debit to an expense and a credit to a contra asset account. No cash involved. However, depreciation or amortization both reduce your net income, so that means they look as if they're going to be reducing your cash, but they don't. So they need to be added back to your net income to get closer to what happened to cash as far as operating activities are concerned. Interest does basically not require any special treatment as far as operating activities are concerned. Your interest revenue and interest expense will be included in your net income on your income statement. So you just leave them alone. And if you have interest receivable or interest payable, you would analyze that in connection with operating activities, not investing or financing. Dividends. There's two kinds of dividends. There's the kind we receive. Those are considered an operating activity. Whether or not you think they're an investing activity, it doesn't matter. The standard calls for them to be listed as an operating activity. But the dividends we pay are considered a financing activity. That's that providing a return to our stockholders. Another item that's unusual that needs special treatment is gain or loss on sale of plant assets. Gain or loss on sale of plant assets or available for sale securities would be down under other revenues and gains or other expenses and losses. Those aren't our primary business activity. They're just kind of like a casual gain or loss that we don't expect to repeat often. So those don't belong in operating activities. They involve investing or financing activities. So we have to get them out of the operating activities. To do that, we do the opposite of whatever the name sounds like. So if it said we had a gain on sale of plant assets, then that made our net income go up. To get it out of operating activities, we would subtract it. If we had a loss on sale of available for sale securities, that would make our income go down, but that's not a primary operating activity, so to get it out of there, we would add it back. So if it says gain, you subtract. If it says loss, you add. The gross transaction amount itself for the sale of the plant asset or the sale of the available for sale security will be reported down under investing activities. And when you handle it down there, the math with it will be the same as what it sounds like. If we loan money out or we collect back from people we've loaned to or companies we've loaned to, that involves notes receivable, and that's considered an investing activity. But if we borrow money or repay it to our creditors, then that involves notes payable, and that's considered a financing activity. So those require special remembering what they are so you don't mix them up. When we use the indirect method of producing the statement of cash flows, which is the one that's mostly used in practice, our operating activities section is done by taking operating income and massaging it basically to come up with net cash from operating activities. So net cash provided or net cash used for operating activities. So we're basically taking our accrual basis net income and operating and converting it to cash basis. So a lot of the differences between that have to do with adjusting entries we've made and transactions that involve revenue or expense but not immediately cash. So all of the evidence of that is typically shows up on the company's balance sheet through current asset and current liability accounts. So if we're going to do operating activities, the special things we have to account for are depreciation expense. That reduced your net income, but it didn't use your cash, so we're going to add it back. And if you're trying to find it, you haven't been flagged for you, then you would look in the accumulated depreciation account and see the credits to the accumulated depreciation account. That would match the debits to the depreciation expense account. Other non-operating gains and losses, as I mentioned above, if there's a gain, like gain on sale of plant assets, then you would subtract it. If there was a loss, you would add it. That's so you can cancel out their impact on net income. So the next batch of things that you work with are current assets and current liabilities. Current assets going up or current liabilities going down both essentially use cash. To increase your current assets, let's assume you have to pay cash to purchase the asset. And to make your liabilities go down, let's assume you have to pay cash to reduce the liability. So both those things have in common that they would use cash. So you could expect when we see information about current assets increasing or current liabilities decreasing, then we would need to subtract them in doing the conversion to net cash flow from operating activity. Liabilities going up or assets going down both do the opposite. We would add them to net income. If your liabilities go up, that means you did not pay the cash. You said charge it. Or if your assets went down, let's say that means essentially you got rid of an asset and replaced it with cash. So a super simple conversion rule for this is if we're talking about current assets and current liabilities and their connection with the statement of cash flows, you start out with net income, and if it's a current asset and it went up, we would subtract its change for the year from our net income. But if it's a current asset and it went down, then we would add its change to our net income for the year. Conversely, if it's a current liability and it went up, we would add its change to net income for the year. But if it's a current liability and it went down, we would subtract its change from net income for the year in arriving at net cash received provided or used by operating activities. So once you reach the bottom of that, you come up with a super important number that's important for the company over the long term. Let's whip through one real quick. Here's an income statement and supplemental information for a company from a text problem at the end of chapter 13. The Whitlock Company has sales revenue of 7.7 million, cost of goods sold of 4.9, gross profit of 2.8, operating expense of 1.15, and net income left over of 1.65 million. Additional information about it is listed below there, and all of those pieces of information are important. So if we're doing the statement of cash flows operating activities section, we would first start out with net income. So that's the amount, that's the bottom line for the income statement. And we'll go through and we'll add or subtract those pieces of information down below that impact cash flow. Depreciation expense never ever involves cash. All it does is involve accumulated depreciation. So it makes your net income go down, but it doesn't use your cash. Therefore, we want to add it back. The accounts receivable went up for the year. And that means that we sold stuff to customers, but we didn't collect the cash from them. So that's income provided, but not cash. So we want to subtract that increase in accounts receivable. Inventory for the year went down by 500,000. So instead of having to pay money to purchase inventory that we gave to our customers, we instead used up old inventory that we had from the previous year. So as far as the current period is concerned, we didn't require any cash in order to finance that inventory that our customers took. So therefore, we're going to add it back. It's like it provided cash because we didn't use it. We didn't have to use cash. Next, prepaid expenses. They went up for the year. The only way for prepaid expenses to go up is for you to prepay them. So prepaid expenses are an asset. They don't impact net income until they're used. So bulking up on them doesn't impact net income, but does use your cash. So we want to subtract that out. Accounts payable for the year decreased by 340,000. The only way to make accounts payable decrease is to pay off more than what you're purchasing. So you pay off more than what you're purchasing. Let's say that all of your accounts payable were for expenses, then you paid more than your expenses were. That means that your cash dropped by even more than the amount the expenses show on the income statement. Therefore, we got to subtract them out. Accrued expenses payable decreased by 100,000 also. The only way to make those guys go down also is to pay cash. Not reflected on the income statement, but does use cash. Got to subtract it out. So a subtotal for these guys is 220,000 net decrease. That means that from the net income we have recorded, all of these factors here impacted it in the amount of negative 220,000. And so the amount of cash that was actually provided by our operating activities is only 1,430,000. Following this would be the investing and financing activities, although this is the most important part, I'd say, of the statement of cash flows. Investing activities involve things that we do to invest in ourselves or investing in others. So when it comes down to it, it really involves a change in some kind of asset account, typically. And so when the asset account changes, we can presume that it's basically a swap of cash for the asset. So if we purchase an asset, then the dollar amount popping up into that asset account, for example, equipment, buildings, land, whatever it is the cost of what we paid to purchase the asset. Or if we loaned money out to someone, that, you might recall, would be a note receivable. So a note receivable being debited would be the dollar amount that we loaned out. When that happens, at that same time, our cash changes. So purchasing an asset and paying cash make the asset go up, but cash go down. If we sell the asset at a gain or a loss, it doesn't really matter from the standpoint of looking at it preliminarily. The main thing to concentrate on is that the cost of whatever the asset was gets credited out of the asset account. But when we talk about the cash we received, we have to look at not only the cost of the asset, but whether we had a gain or loss on it. So therefore, to recap, on the purchase side, it's super simple. Whatever you paid for the asset, count that as cash paid. But on the sales side, the credit for the asset represents the cost of the asset that we got rid of. And so the actual cash needs to be converted. If you had a gain, then you received more cash than what the asset cost you. So you would take the cost of the asset that you sold and add any gain to compute the amount of actual cash that you received. Or if you sold the asset at a loss, you take the cost of that asset, that's the credit to the asset account, and subtract the loss. This gets a little bit more complicated when it's not something simple like land. When you have something such as depreciable assets, then the book value of the asset sold is used along with the gain or the loss to compute the actual cash received. So book value is the cost of the asset minus its accumulated depreciation. So three accounts would actually be involved in the computation. So notice we only have to do this gain or loss thing on the sales side. The purchase side, super easy. Just the amount of cash is what the asset cost us. Financing activities. To do financing activities, you analyze all your non-current liabilities and your equity accounts, and essentially those guys tend to be sources of cash. So if a liability goes down, the only way for the liability to go down is for us to pay it. So a simple transaction would be repaying a note payable, or for example, repaying a note payable. So repaying a note payable would make our liability go down and would make our cash go down. However, if we borrowed money, then that would make our liability go up and our cash go up. Another example would be issuing stock. So notice over here this says liability or equity. So if this was, say, the common stock account and we issued stock exactly at par, then we would credit common stock for the amount of cash we received, and we would debit cash. So seeing that the common stock account increased by $1 million would tell us that we got at least $1 million of cash from issuing stock for the period. So that's the primary items that you use in coming up with a statement of cash flows. The most complex of all of these in investing activities has to do with cash received from sale of a depreciable plant asset. So the depreciable plant asset would essentially say cost of plant asset. Let's say its cost to us was $1 million, and accumulated depreciation let's say that was $300,000. The book value is the net of the two. So if you have a gain, then let's say we had a gain of 150,000, then our cash received from sale of plant asset would be the $700,000 book value plus the 150,000 gain. However, what if it was a loss on sale of plant asset? If it was a loss on sale of plant asset, and let's make that one a different amount. Let's call that 210,000. Then the cash received from the sale of plant asset would be the book value minus the loss. or only $490,000. Thanks. Good luck on your homework. Bye now.